Hi, this is Pat Moorhead with More Insights and Strategy, and we are here for a special edition of the 6-5 podcast. You know, we have made it every week for multiple episodes. I don't know, 100 and some episodes, and sometimes we do six topics, sometimes we do a special edition. And here we are for a special edition. We're here to talk about Cisco earnings that has created a lot of chatter. Not just about Cisco, but the overall market as a whole. I do want to remind everybody, though, that the 6-5 podcast is for information and educational purposes only. We will be talking about Cisco, which is a public company, but don't take anything we say as investment advice. So, Daniel, what is it that created all of the hullabaloo? There we go. I'm a boomer. No, I'm not a boomer. I'm Gen X. I use hullabaloo.
Is that even a word? I don't know.
I don't know.
Yeah, great point, Pat. We do like to get out every week, but I think this morning you were actually with another big IT VAR, IT OEM, right? With HPE.
I was
with the CEO Antonio Neri. I saw that beautiful picture pop up on LinkedIn. Everybody go out and like it right now. Go like Pat's, but Pat loves when you like his posts.
Even better, sign up for the 6-5 Summit. It's going to be it is the best in tech thought leadership that you can get in one place, June 7th, 8th, and 9th. Head to the 65summit.com. It's free of charge for the best content.
Look at us, man. We can't even get to the content. I change direction, you change directions, but let's get back in the direction of the topic at hand, Cisco. So listen, the market is in a bit of disarray right now. Tech is a little bit unsure. I think I've thrown that statistic that more than 50% of the NASDAQ is down by 50%. Right. But there have been some safer havens, and some of the safer havens have been the big, steady IT tech, companies like IBM, like Cisco, that have been very consistent, that didn't necessarily see huge multiple growth during the pandemic. They pay yields and dividends. Their revenues have been predictable. Their customer bases are tremendous. But we also saw what happens when giants miss in a market that is as volatile as this one. And I think Walmart, Target have been a great example with their recent woes. And Cisco came in a week when the market started to feel a little bit of gyrations with a credit bubble looming, with potential supply chain issues getting worse, with China having some intermittent shutdowns, a war that just won't seem to stop, can't seem to find peace. And there's uncertainty, and that's led to companies cutting off business in markets. And in Cisco's case, that was a multi-$100 million setback this quarter between the war and the shutdowns. And even as strong as semiconductor numbers have been this last quarter, the difference between a chip maker finishing the product and then shipping a chip to a company like Cisco, who's then going to assemble and build a product, is there's a whole nother wave of manufacturing that has to happen. So when China goes down for a week, 2 weeks, 3 weeks, that can create material setbacks in terms of revenues and shipments. So Cisco missed, Pat. Cisco missed on the top line substantially. Now, it made on the bottom line, so that means it operationally did well, took advantage of some elasticity in the pricing, and there were some other good numbers in there, by the way. So the revenue was flat year over year, but people were expecting it to be about $500 million higher. But look at the backlog. The backlog is a record backlog now, Pat, up 10% sequentially and up 130% year over year.
Yeah, totally.
Which means, go ahead. I'll pause because there's so many directions to go. Go ahead.
Yeah. So if the backlog wasn't up, then I would be concerned, because if you can't get the equipment in that you need assembled, then you can't ship it, and your backlog goes up. And the only reason it wouldn't is if it was diminishing demand, but this type of demand is fungible. And to put a number on what it meant for Russia and Belarus, that was $200 million in the quarter. So that brings the answer to half of the top line miss. And I want to put a spotlight on. You did a good job talking about Shanghai. I want to do a double click on that. So it's one thing to get the chips, like you said. You need a chip shooter to put it on a PCB, which then creates a PCA. and then you need the metals, then you need the plastics that are done through plastic injection molding, and then all this needs to be assembled and shipped. But Shanghai, which by the way is not the largest port, it is one of the biggest ports out there. Typically, a lot of this stuff happens in the south, but there's still a lot of manufacturing in the north, and this is what hit Cisco. So literally, everything looked to be really good, and whether it was the number of subscriptions, whether it was ARR, whether it was looking at what they call RPO, which is remaining performance obligations, was $30.2 billion. That's another way to look at a backlog. Heck, even software backlog was up 10% sequentially, grew 80% year over year. So it is kind of
that's $2 billion in a software backlog.
Yeah, and it's kind of bizarre having this conversation right now because, aside from that very important revenue number, and then the stock takes a hit. And one thing I wanted to talk with you about was, is this fair to do to the stock? Or does it really? I mean, listen, you and I, we both studied finance in one way, shape, or form, and essentially the stock price is the weighted average cash flows from here until eternity, right? That is what is supposed to technically create the value of a company. But did we really get a 15% haircut on the overall long-term value of Cisco based on Ukraine and COVID lockdowns in China?
Yeah, well, first of all, that's the question I think tech execs are asking across the world, Pat. I mean, you and I have been on a bit of a listening tour over the last month because of the 6.5 Summit and just getting back out to events. We've sat down with Arvind Krishna at IBM. We sat down with Christian Klein of SAP. You were with Antonio. We were with Matt Murphy of Marvell this week. And I talked to Rowan Trollope of Five9. So I think there's a nice collection, just in the last week, of a nice collection of CEOs. And I've been asking the same question, kind of like, I think tech ultimately is the answer to solving a lot of our problems. The supply chain will be solved with the implementation of technology. Our privacy and security issues are all going to be solved with AI, ML, observability, other technologies. Our automation is going to solve the workforce shortage that we have right now. It's going to have to play a big role. And my point is that all of them are largely seeing growth in revenue. They're largely seeing growth on earnings.
Right.
They're seeing net revenue expansion. Their backlogs are growing. And even in a downturn of the economy, most of them don't see any significant fall in terms of the demand for technology products. So is it fair? Well, is Zoom worth 1/5 of what it was worth in the middle of the pandemic? Well, it's had significant revenue growth throughout the entire time. So it's doing more revenue with more customers, with more products, but higher interest rates, inflation, a massive policy issues, a complete lack of strategy to deal with the fact that we don't have stimulus. So there's a lot of macro factors, but I think the number one thing, Pat, and Rowan said this to me, I say Rowan Trollope, Five9, just in case you don't know him out there, he said it's one thing. He said it's interest rates. I think it's more, but I do think when you really try to zoom out a little bit to your point and look at the whole situation, Pat, the market is basically discounting the future growth and cash flows that you mentioned when you set this part up. They're discounting it. You remember Chamath said this, we were at the All-In Summit this week. Right. Chamath Palihapitiya said when you look at growth companies, you look at startups, for every 1% interest rate hike, you have to discount future growth 15%. The market's looking at anywhere from 2 to even up to 3-4% in order to curb this inflation. So if you look 3 to 4% of interest rate hikes, that could be a 45 to 60% discount on growth. But for companies that create cash flow like a Cisco does, like Microsoft, like Amazon, really hard for me to not see this as a great opportunity. Again, not financial advice, just saying if you like Cisco at 50, probably like it at 40, right?
Right. And it's interesting how we're just casually saying that the value of a stock isn't really, the stock market doesn't actually monitor the value of a stock long term. And maybe it's just me doing the wake up call, but I do always like to point that out. Fundamentally, the long term value that Cisco is providing is not 15% less than it was the day before. And I think it puts a I don't know. I don't know if it's a damning of Wall Street or it just is what it is, but is it really just some big meme, meme thing now?
It's algorithms, though. I mean, so much of this is algorithmic. Do you think that when Walmart dropped or Target dropped 25% in a day, that was all people physically opening up their portfolios and being like, "Oh, I'm done with Walmart."
I'm done.
I mean, it was literally some line of code in a spreadsheet somewhere that basically said, if else this happens, then sell. And then you've got a cascading effect of algorithms. I mean, look, I don't know that the SEC does anything anymore. I mean, I really have no idea, and I'm not trying to get into like that wormhole.
Right.
But my point is like, there was a time when the idea of picking a company was exactly what you said. You're looking at revenue, you're looking at earnings, you're looking at cash flow, you're looking at the management team, and you're saying, the
Right.
Buffett style of investing, right? The Warren Buffett. And by the way, over the long term, it seems to work. The problem is, and I'm serious about this in our world, is immediacy has become a bit of a nightmare, whether it's social media, whether it's, basically being guilty of something before you even have a chance to explain what happened, the way media, the cancel culture that's out there. And the same thing is with companies. Like a company doesn't even have a long enough time to finish an earnings call before the stock gets destroyed to maybe even come on and explain what might have happened and why there's a very positive future outlook. You know why most companies stop giving guidance in their initial press release is because they're hoping at least people will get onto the earnings call and listen before they start selling. So, now we can see our portfolios up to the second. You got the tickers running all day long. You're getting alerts from your Coinbase account to tell you that your crypto is worthless. And now even our real estate, you get a notification that your real estate's losing value. I mean, what do you think is going to happen when you emotionally inflict these kinds of wounds on society and then you add algorithms? It's I know I'm going down a bit of a wormhole here.
No, but this is exactly the type of conversation I think that this warrants. I think you and I are both, we see it every day and we live it, but it doesn't mean that we have to accept it and think it's a good thing, right? And I think that's what we're talking through is the kind of the lunacy of where we are. And I think the impact that, I think Cisco employees and Cisco ecosystem partners is they need to look at this same thing. I mean, a lot of earnings coming up in the next 2 weeks, right? Let's see what happens. I'm hearing that it's going to be Shanghai is going to be a big issue for some customers. We saw what Russia did to SAP. So any company with April where revenue is included in their earnings, that apparently that is the month that's going to be scrutinized in reality.
Absolutely. And I mean, look, all these companies, there's a reason to potentially discount future value based upon not liking the strategy. Meaning, I could understand someone looking at Cisco and saying, I don't see their consumption model growing fast enough. That could be a reason someone might be concerned. But based upon the company's role in cloud scale infrastructure, at the edge, in the network, the size of its customer list, it just doesn't make a lot of sense based upon some of these very short-term items to be so discounting of its capabilities. Having said that, though, Pat, I think this is a perfect snapshot and moment in time for us to say this is exactly how the markets act now. This is what everybody has to be used to. But just don't conflate the two things. Don't conflate a sell-off of a really good company and whether or not it's
with its actual performance. Yeah,
a really good company.
Exactly. Yeah, and I think it's a great place to end, Daniel. And I'm glad we did it. Glad we talked about this. And It was funny. I had a lot of conversations this week about Cisco earnings with some really interesting people. So great topic, Daniel. And for this week, this is 6.5. We are busy working on content for you for the 6.5 Summit, no charge, 20 CEOs, 72 speakers across 12 different topics that I know one of them you will like. So sign up. The content's going to be gated for 2 weeks on our site, but dive right in, the65summit.com. Also, if you like this show, hit the subscribe button. Let us know what you think on Twitter. Have a great weekend. Take care.